Hey guys, welcome to the video. I've been investing for just over 3 years, and so far I have outperformed the S&P 500 index. My goal is to continue this over the long term on a 5 to 10 year horizon. I have been able to achieve this by following Warren Buffett's investing methods. At the time of this recording, my portfolio over the past 3 years has returned 22.17% per annum, while the S&P 500 index has returned 13.33% per annum. So, let's dive into how I was able to achieve these results the Warren Buffett way. The first key concept that I learned from Warren Buffett is to stay inside your circle of competence, especially if you want to outperform the market. Listen to what Warren has to say about that.
Old-fashioned belief that I can only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean, understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do. I understand the economics of it. I understand the competitive aspects of the business.
The reason this is so important is because it gives you the confidence you need to hold on to the business in times of crisis. When you truly understand a company, it helps you to forecast and have a general idea of the direction its fundamentals are heading. When news comes out and the stock price goes down, based on your true understanding, you'll be able to determine whether this is a buying opportunity or not. When you don't understand the company, you won't be able to recognize fundamental issues that could damage the longevity of the business, and it could lead you to losing money in the market. And that is exactly what happened to me in my early investing journey. The second key lesson to outperform the market is to have a long-term mindset. You need to think long-term. As the late Charlie Munger said, in investing, the money is not made in the buying or selling, but it is made in the waiting. To emphasize Charlie's point, after doing all the hard work to find a good company, all you need to do is hold on to it. Holding on to your winners is key to investing, and it is how you outperform the market. As long as your companies are still growing fundamentally and performing fine over the long term, the stock will follow. Do not let market volatility scare you out of your position.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the
Zero.
company's in?
This
No?
is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets that the long-term holder has his quoted value of his stock go down and then by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50%, 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get.
As you saw in that clip from Charlie, even the best and biggest companies have big sell-offs, and if anything, they represent a good buying opportunity. So, let me give you this scenario. Let's say you invested $100,000 into the S&P 500 in 2003, and you did nothing besides hold that money during the 3 bear markets in between those 2 decades that lasted a combined of 2 years and 4 months. Just from holding your money, it would have grown to $647,854. That's pretty good, right? Considering you had to do nothing but sit on your hands and wait. However, let's say you were to panic and sell it in just the 5 best days during that time. Your portfolio returns would drop to $409,182. Just selling out on the 5 best days could have cost you more than $200,000 of gains, meaning you have lost a third of what you could have earned. This is a lesson to not panic sell. No one knows when the 5 best days are going to be. The only way to make sure you don't miss it is to just stay invested for the long run. The next key concept is to look for a business with high returns on capital. If you invest in a business that can compound high returns on capital, you will likely outperform even if you overpay. Return on capital is a financial ratio that measures how profitable a company can be with the money it invests. You want your company to be earning high returns on its invested capital. The term is interchanged with ROCE, which is return on capital employed, or ROIC, which is return on invested capital. The late Charlie Munger once said, "Over the long term, it is hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result." Okay, to demonstrate this point, I'm going to give you a hypothetical scenario. Look at this graph. The blue line is company X that earns a 30% return on capital, while company Y, which has the green line, earns a 10% return on capital. The numbers above show the return on $100 invested at the company's respective return on capital with the 50% reinvestment rate. Just look at the significant difference in the performance of the companies over 10 years. High returns on capital is a very important trait for a company to have if you want to compound your wealth over the long run. What I'm about to show you is some of the best companies in the world and their average annual return in the past 10 years and their return on capital over the same 10 years. Pay attention to how close the two are correlated. Our first company here is Costco. In the past 10 years, it's had an average annual return of 25.73%, and its return on capital over the same 10 years has consistently been around 20%, as you can see. Yes, it's deviated up and down below that mark. However, overall, it's been around 20%. Next up is Fair Isaac Corporation. In the last 10 years, it's had 42.01% per year, and in the past 10 years, its return on capital has been slightly growing, trickling all the way up to where it was 53% last year. Next up is Google, one of the biggest tech companies in the world. Over the past 10 years, it's averaged 18.21%, and its returns on capital has been consistently growing, so to the point that over the past 3 years, it's been over 20% per year, over 25% in fact. Next up is Visa, the payment processing company. In the past 10 years, it's had 19% per annum, while its returns on capital have been consistently above 20% per annum, reaching as high as 31% last year. And then last but not least, we've had Apple. Apple has averaged 25%, just underneath 26% over the past 10 years, and its returns on capital have been almost sky high at 30, 20%, 48%, getting up to even 60% in 2022, and then coming back down to 55% last year. So the big lesson in all of this is to look for companies with the higher returns on capital. The companies in my portfolio have a high return on capital, and you might be asking, what is considered high? Well, to me, that figure is around 15% plus, preferably. Listen to what Chuck Arcree from Arcree Capital Management has to say about this.
And extraordinary companies.
Compounding machines.
The compounding machines, right. So why is it so hard to find those companies?
Well, they're scarce.
Yeah.
They have something unusual going on, and oftentimes it is not completely obvious as to what it is that's going on. A great example of that would be a company like MasterCard or Visa. They're earning returns on capital that, as we say, you could cut in half twice and it would still be above average for an American business. So something extraordinary is going on there.
Right.
And the company does not talk about what that is. They never talk about it. We don't talk about it, but we spend a lot of time thinking about it, trying to understand what it is, whether or not it's likely to continue, that sort of stuff.
Why don't you like to talk about it?
I don't think we're giving away anything, but I just want to make sure we're not.
Okay.
It's just that simple, you know. And so the other side of that is a company like that earns rates of returns on the owner's capital that are so extraordinary that they don't have a good opportunity to reinvest their free cash flow in ways to continue to earn those above average rates. So what they do with their free cash flow is they buy in shares, they pay a cash dividend, they make small acquisitions in technology around their space, but it's a challenge to utilize all the free cash they generate. And unlike our ideal company is one that can keep reinvesting and earn outrageous returns on capital.
Right.
The last key step that has led to my outperformance of the market is to stay concentrated in my best positions and not diversify. Charlie Munger used to say, why put your money in your 8th or 10th best idea when you can put it in your 1st, 2nd, or 3rd? The ability to stay concentrated in the best stocks is what will drive your performance up. To be so concentrated also has to do with your own confidence in your abilities. And the first key concept we discussed in the video, which is knowing your circle of competence. If you truly understand the businesses you own, it's easier to stay concentrated. Listen to what Chuck Arkley has to say about that.
Now,
And the other part of my question should be, when I talked to you in 2014 that you had 30 holdings, you're now down to 17, you've got a ton more money. Shouldn't you have more holdings? So go ahead.
Right. So we always talk about our ability to do better than average.
Right.
And so when you think about average, so when I think about average, I don't necessarily think of our AUM. What I think of is our ability to stay concentrated. So give me an example. If you flipped a coin, the average outcome would be that 50% of the time it would be heads and 50% of the time it would be tails. The more coins you flip, the more likely you are to get to average. 50% will be heads. The fewer coins you flip, the more likely you are to get an outcome that deviates positively or negatively from average. And I think
So you're flipping coins, Chuck. You didn't know that. Okay.
so.
Okay.
But that's what I mean by
So that's the philosophy.
So it's really not about our AUM. It's our ability to stay concentrated in our highest conviction ideas, and our AUM hasn't been a problem to date.
in 2014, if we had 30 or 35 holdings, we would have been at that point in time less confident in those names than we are in the 17 holdings today.
Okay.
So if you see our holdings go to 35 again, you should just understand that it means we are less confident in the characteristics of the group as a whole, and that's why we have it spread out. And then the concentration, pure concentration, is we want to have as much money invested in the great businesses as we possibly can, because our return will come from their good experience. We will be riding on the back of those great businesses. So that's why we want to have all this, our capital concentrated in those things.
So, to summarize some of the key concepts that we learned today, the first concept is to stay inside your circle of competence and know what you own. Secondly, have a long-term mindset and don't panic sell. Thirdly, invest in high-quality businesses with the higher return on capital employed. And lastly, is to stay concentrated in your best positions. So, that's all we have for today, guys. Thank you guys for tuning in, and I will see you in the next one.